this document must be maintained as a dentist. Now, how do you manage your expense? Now, if you look at that expense management, tracking your expense is the major key for the success of your business. Now, tracking expenses, it's a foundation of financial control. Because if you are not tracking your expenses, you cannot control your expenses. So, break down both your practice and personal expenses. Don't mix up with personal and practice expenses together. Majority of the people will make the blunder mistake maintaining both the things in the same account. You need to have a separate account for your personal related expenditure and similarly business related expenditure, separate account, because business entity is always called as a separate individual as per the legal procedure, right? It can buy own assets on its own name. Company can buy assets. TCS can buy building. TCS can sell building. So any property can be purchased by a company or any kind of organization, whatever the organization you have. So similarly, so any form of organization, even sole trader. So your clinic might come under sole tradership, which is also a legal entity. Partnership, which is also a legal entity. Right? Sole proprietorship, what? The responsibility, the liability and responsibility fully fall under your head. Whatever the profit you are going to gain, entire profit is belong to you. Suppose if you are facing losses, heavy losses, you have to incur. That is what sole proprietorship. Partnership, in the sense you are going to share the losses. But if in the case of company, the investment is limited. Suppose if you are investing 10 lakhs, up to that 10 lakh only you are responsible to settle down. We already invested in the stock. So that only will be loosed by you. But beyond that, you are not responsible. That is what Anil Ambani gave yellow notice some time back. We can't do anything once if you issue yellow notice for the company people. Right? But if it is your own business, like sole tradership, if you need to pay a huge amount and you are responsible, they will go to the court, you have to settle down. Your investment might be 10 lakh, but your liability become 20 lakh, you are responsible to pay 20 lakh for sole traders. So your business is come under sole trader, or it may be if you are one or two people join together, you start your own organization under partnership, it's come under partnership. Again, it is a separate legal entity. Now, please try to understand that you have to break down both practice and personal expenses, then only you are able to manage them. So, you need to always have a current account for business purpose. Personal purpose, you may have a saving account, but business purpose, you need to have a current account. N number of time you can do the transaction, there is no restriction for it. But for savings account, withdrawal, there is a limit for a week. Right? In a month, if you are crossing more than 5 times, the charges will be applicable. But current account, there is no much charges for n number of operations. So you need to have a current account. So manage loan, EMIs and lifestyle creed to maintain healthy financial balance. You try to understand that we need to manage your loan EMIs periodically, lifestyle expenditures. So these are all things need to be maintained. So what are the practice expenses? Like you may pay the rent for your office premises, like your clinic. Equipment might be purchased, right? Supplies, dental supplies, and then staff salaries. So these are all things are come under operational related expenditure, that is called as practice expenses. So personal expenses, say for example, if you are paying rent for your own house, right, or you are paying maintenance for apartments, these are all things are come under personal expenses, like transportation, commutation expenditure from your home to hospital. And then you are providing education for yourself. You may be completed BDS, you are going for MDS. You are borrowing the loan for it. All these things are come under personal expenses. Or you may give the education for your kids, that is come under personal expenses. Or it may be you are spending for family needs. All the things are come under personal expenses. Don't mix up with business expenses and personal expenses again. And effectively you have to manage your loan EMIs. Whether it is education loan, or it may be establishing hospital, or it may be a personal loan, whatever it may be, First of all, you need to settle down the loan which is having the highest rate of interest. Say for example, the credit card need to be settled down very faster than any other loan. Because if you are failed to pay on time to the credit card, it become double. And after that, it become triple. Right? So you have to sell your property and settle down for credit card bank. Right? So this is what the things will happen over the period if you are failing to pay on time. Fines are very high in the credit card system. That's what the maximum interest payment loan you have to settle down with minimum payment loans. So you can identify where there is an avenue to get a minimum rate of interest in the government banks, and you can settle down this kind of loans. Lifestyle creep is nothing but identifying and managing unnecessary spending, unwanted spending. So there are sometimes what happens, unnecessary spending is nothing but, see, morning if I am going to have a breakfast, it's an essential need. Food, shelter, accommodation, all the things is a fundamental needs. Suppose if I am going for in between break and I am having pizza, burger, all the things, it's a want. It's not essential. I can avoid that. It is going to harm my health also. Right? It is not essential. Food is essential. So that is what you need to understand, the difference between needs and wants. So these are all expenses is categorized two major categories, fixed cost and variable cost. When you talk about the cost, is nothing but it's an expense. So as I told you, fixed cost, the rent, it's a standard rent you are going to pay for a year throughout the period. Right? Normally, technically if we talk about, we are going to say that it is a semi-fixed cost. Partially fixed, partially variable. So I don't want to confuse you. That is what the reason we have given fixed cost, rent, salaries, insurance. So these are all, and even software subscriptions, all the things you are going to pay in a fixed manner. So that is come under fixed cost. So there are some cost expenditure which is come under variable in nature. It is based on the every practice, every patient you are going to use some materials. So that is come under variable. Number of patient, number of material used. It's keep increasing your cost based on the number of patients. So dental supplies, lab fees, utilities, marketing, all these things is happen for short term. So these are all things that come under variable cost. Apart from that, there are some cost is come under hidden cost. Like equipment maintenance, we are not able to understand at what time we are going to get affected for the maintenance issue. So equipment maintenance, staff training, suddenly staff need to be given the training, and then compliance fee. So these are all things is called as hidden cost apart from your operational cost. And if you look at the last item, capital expenses. So suppose if you want to buy a new equipment, right, or you want to do clinic renovation, technology upgrades, all these things you need a huge investment on it. It may be a longer period, minimum 3 to 10 years duration it will take. Anything if it is exceed more than 1 year, that is come under long term. Within 1 year it is called as short term. So these are all things are terminology of finance. Now if you look at that, what kind of strategy we can apply to control expenses? Please try to understand that the variable expenses can be controlled for negotiating with your supplier. So you can make a contract to buy in bulk. If you have more number of patients to treat, instead of buying installments, you can buy in bulk and you can negotiate the prices when you are buying in bulk. So that is the way you can reduce the expenses. Second thing, reducing the waste, that is a matter of concern. So if you keep on wasting the materials, that is increase your cost of operational expenses. So reducing the waste, optimizing the resource utilization. So that is also a matter of concern. So then only are you able to, these are all the strategy you have to implement to reduce your expenses in general. So I am just giving the outline. The next two parts ask me that depreciation. See, this is applicable for the long term item like equipments, machineries, whatever the equipments, long term equipments you are using. Depreciation is a matter of concern. Many people does not understand that depreciation. Once if we invest 10 lakh rupees for a particular equipment, we forget about completely. After 10th year only we will go and put it in the account in general without knowing the accounting impact, which is way too ridiculous in general. Now depreciation is a loss which can be deduct from your annual profit. So if you are reducing this loss from your profit is 1 lakh rupees, your depreciation is 25,000 per annum, in the sense if you can subset or you can apply the depreciation from 1 lakh to that 25,000 can be deducted, remaining 75,000 is a taxable income. For that you can pay the tax. So that's what I am trying to say. Depreciation can be treated as one of the expenditure. Loss and it is normally called as loss, but we are not going to pay anything for depreciation. To be honest, if you are going to talk about, once if you buy the equipment for 10 years, you are not going to spend anything for that apart from maintenance. But every year we are going to calculate the depreciation that will be treated as a loss or expense. You try to understand that you are not going to pay even a single rupee from your pocket on that particular period. But you can bring it to the statement of account. Now what is depreciation? Why it is important? A company or organization charges depreciation. Why it is charges depreciation? So avoid charging all cost on one particular year, end of the 10th year, end of the 5th year, the lifetime is over, that particular time I'm going to fix it. New equipment I need to buy. So I need a huge amount. Instead, if you are going to allocate the depreciation loss and provide a depreciation fund in a different account, 10,000 or depreciation for this year for that equipment, you put that 10,000, you are not going to pay for that equipment for depreciation. That amount you deposit in a depreciation fund account. End of the 10th year, you need not borrow the loan. You can make use of this depreciation fund to replace your new equipment. Right? So that is what the reason you can avoid the changing all costs in 1 year. You can show the true and fair view of your accounting statement every year. Why? Because depreciation every year we are going to apply for partially for each and every year. So that's what the reason accounting statement also it will reflect in fair view. So you are not going to overstate fixed asset. If you look at the company financial statement, you cannot edit company financial statement once. If you buy a fixed asset machinery always 10 lakh rupees, in the sense 10 lakh rupees only. So that is what we are overstating fixed asset in general. So you cannot change the land value. I maybe purchased land at the rate of 40,000. Right, in the year of 2006, I bought a piece of land at the rate of 40,000. Today it is 12 lakh rupees per cent. When I bought it is 40,000. So today I cannot change my financial statement to 12 lakh rupees per cent. Whatever the purchase price, that only I have to reflect. That is applicable even for machinery. But then you can apply depreciation. 10 lakh rupees machinery in the sense, 10% depreciation in the sense, 10,000 you can deduct, 1 lakh, 10% of 10 lakh, 1 lakh you can deduct, remaining 9 lakh you can project in the financial statement. That is possible. So you can write off fixed asset over the period of time. That is what the reason we are going to calculate depreciation. So depreciation, how depreciation is estimated? It is based on three things: cost of asset, and then the life of the asset, and the third thing, salvage value. Salvage value, or we can say that it is a scrap value. Right? So the remaining equipment. So say for example that you are investing in a car, the car has been used for 10 years. So you will sold out that particular car or equipment after 10th year, a meager amount. That is what is called as salvage value or residual value or scrap value. All are same. In general, minor technical difference will be there, but we use the same terminology in general in accounting purpose. So these are all the major three things you are going to apply. And how we are going to apply for depreciation? There are two methods in general for across all services industry will apply. We have many methods. Revaluation method, all the things are there, but then that is applicable for manufacturing concern. Service industry only there are two methods you are going to effectively apply. One is straight line method, another one is reducing balance method. What is straight line method? You try to understand that there is a formula will be applied for straight line method. Right? The cost of the asset minus scrap value divided by the life of the asset. Say for example, I purchased 10 lakh value of equipment. The scrap value end of the 10th year, if I am going to sell that machinery, I can sell at the rate of 1 lakh rupees. Right? So remaining 10 minus 1 lakh, that is equal to 9 lakh. The life of the equipment is 10 years in the sense divided by 10. So effectively you are going to pay 90,000 per annum as a depreciation. For 10 years you are going to apply 90,000 in your financial statement. From your income you are going to reduce that loss. You are not paying tax for this 90,000. You may come under 30% bracket, tax bracket. So 30% of 90,000, you know that. It's not 10,000, it's close to 27,000. So 30% of 1 lakh 30,000. So please try to understand that unwantedly you are paying government. The tax amount will be paid to the government of India. So that's what the reason we are going to subset this particular amount. So straight line method, in the sense every year the same amount 90,000 will be applied. But reducing balance method, straight line method also called as fixed installment method. That is what same amount we are going to apply. Now return down value method or reducing balance method, a certain percentage for that particular equipment, they may mention in the equipment itself every year the wear and tear is happened 10% or 15% or 20%. You know that you already used that machine. So 10 to 20% you can apply wear and tear. So 10% if I am applying, 10% of 1 lakh rupees, or say for example if it is 10 lakh equipment, 10% of 10 lakh rupees, which is 1 lakh rupees again. Now you can apply for 1 lakh first year. So remaining 9 lakh only the next year opening balance of that equipment. So you try to understand that the end of the second year, 10% again I will apply for that 9 lakhs only, not 10 lakhs. So it become depreciation, become 90,000. So it will reduce. It become end of the year, the asset value 81,000. So beginning of the third year, it become 81,000. So again 10% end of the third year, 8,100 rupees will be the, or 81,000 will be the depreciation. So that is what I have given a small example for your understanding. Machine X or equipment X cost rupees 20,000 is expected for 4 years. The life of the asset will be 4 years. So now the scrap value is given. So end of the fourth year that equipment I can sold out for 2,000 rupees. That is what salvage value I am getting. So in that case, what is the formula for straight line method? Original cost minus residual value divided by expected useful life. That's why I said 20,000 minus residual value 2,000 divided by the estimated life of that equipment. If you apply effectively depreciation for every year, you are going to pay 4,500. The year 1 4,500, year 2 4,500, year 3 4,500 and year 4 4,500. If you connect in the right expenses part, you know the X column is year, the Y column is amount. So when you connect all the 4,500, it will come straight line. That is what is called the straight line method in general, because it's a similar amount of depreciation for every year. Now reducing balance method or return down value method, if you look at this example, this equipment, Y equipment is 10,000. I am applying depreciation per annum 20% in the sense, so there is no residual value. Suppose some of the people, they don't want to sell up that machine or equipment end of the day. I don't have a time to sell all these things. Fine, well and good. You can use 20% for that 10,000. 2,000 is the depreciation. So look at that, 10,000 minus 2,000 remaining 8,000. That is what the closing balance of that particular period of your equipment. And the next year, beginning, the same 8,000 only will carry forward. And end of the second year, again 10% you are, 20% you are going to apply, that is 1,600, 8,000 into 20%. So these 1,600 need to be deducted from 8,000, or we can collectively add up all the depreciation from the 10,000 you can deduct. Both the things you will get 6,400 only. It's a lump sum method, that is depreciation alone we are deducting. So 8,000 minus 1,600, the remaining amount 6,400. So now opening balance of third year will be 6,400. End of the year again 20% I am going to apply. You look at the depreciation, it starts with 2,000, next year 1,600 and following year 1,280 for all 3 years. It's keep reducing. That is what the reason it is called as return down value method or reducing balance method. Now another strategy is budgeting. So budgeting for a sustainable practice. See, end of the day we have to be in the business for a longer period. We have to apply some strategy, budgeting strategy. Now you have to create a better budget. Plan. Budget is nothing but we are going to plan better. Even Government of India is preparing budget. State government is preparing budget. All family people will prepare the budget. Right? All family women, they are preparing the budget. How to manage your family expenditure. So budget is nothing but it's a plan of action. So creating effective budget based on your experience is a matter of concern. And try to understand that you have to continuously monitor your budget. how you are able to effectively monitor, actual expenditure. You already have a budgeted figure. This is what the amount I am allocated for that. But then the actual expenditure may go ups and down. So you have to continuously monitor. Accordingly, you have to revise your budget. That is what monitoring. Adjust accordingly that particular budget. So if it is exceeded beyond your limit, sometimes it is not under our control. Unexpected reason. Suddenly corona, pandemic has come. So we won't expect. But then we have to adjust the budget accordingly. We may have a budget in a different mode, but now things are changing. Now effective budgeting strategy, if you look at that, implement effective budgeting strategy, use 50-30-20 rule. As an individual, you have to always use 50-30-20 rule. What is 50-30-20 rule? It is applicable for all the people. You try to understand that 50-30-20 rule in the sense, allocate your income, the entire profit. You have to allocate for your needs and wants and savings. 50% of your income you can spend for your needs. That is very, very essential. That's what I already told you. Food is very essential. Shelter is very essential. Right? So all basic needs, right, you have to fulfill. There is no other alternative. For that you can spend your 50% of income. 30% we used to spend for our wants. Suppose if we are going out, I look at, my wife is look at a very good vanity bag in the sense she want to buy. It may be cost around 5,000 rupees. It's one. It is not essential. Right? So that is what. You try to understand that. For that we can spend 30% of your income. And then savings. The remaining 20% mandatorily you have to save. Every year 20% of income minimum you have to save. Then only you are able to build a corpus fund for your retirement life. Next, for running the business, you have to start always with zero. Zero-based budgeting need to apply. Every month you have to start your account, cash account with zero balance. Why I am saying zero balance? Every rupee need to be allocated some purpose. I already told you, 100 rupees you have, 50 rupees for need, 30 rupees for wants, 20 rupees for savings. Allocated. So next month zero. I am starting with zero. Zero-based budgeting. Right? And then you have to apply envelope system. If you are using physical cash, you are never used for mobile technology, all the things. If you are using physical cash, you know that you can use envelope system. All you can use for variable expenses to avoid overspending. First monthly salary vandonne takna rent ke evoloppa the cover thiki podu. Milk ivanukku kodukonu, water can ulla kodukonu, cover la potu thaniya vechitonu vechukonga. There is no need to worry for that particular person standing in front of us. Ayyo kaasli naikuriya solla thevilla. We prioritize our spending. So that is what it is called as envelope system. So let us move to tax planning. So my topic is financial wellness. That's what I am giving overall guidelines, and then come to the cash income and expenses preparation in the Excel sheet. Tax planning and compliance. So I am going to talk about personal tax planning. Understand your tax obligations. First of all, you need to understand your tax obligations. Maintain accurate record. If you run a business, you have to maintain your accurate record. As I told you, your case register need to be maintained for revenue generation. That is mandatory as per legal requirement. Suppose if you are selling any goods, health services will not come under GST. It is exempted in India. But then, if you are selling any product, as I told you, if it is exceed 20 lakhs, you are come under GST. You have to get GST number. And try to understand that if your income is exceed 50 lakhs, you can opt for presumptive taxation. See, if you maintain more than 95% of cash receipt based on mobile application or bank digital mode, so you need to pay only 5% of GST. Suppose if you are receiving the cash mode more than 5%, that is less than 95%, right? In that case, what will happen? You have to pay 8%. That is the rule of Government of India for services in general, which is apply here also. if it is product sale, right? Any product if you are selling. And always you seek professional guidance from your auditor. So if it is exceeds a certain quantum of amount, you are facing difficulty for personal income tax, always seek professional guidance where you can invest, where you can save the money. And stay informed about changes in tax laws. Tax law is keep changing, right? Always Mimi and is keep changing the rules and regulations. Consider tax saving strategy. So apply tax saving strategy. File and pay taxes on time. Otherwise penalty will on the way. So please try to understand that. Don't play with, right? Our Mimi aunties, she will send a mail for you. Okay, fine. Now smart tax. What is the smart tax planning in India? Plan your taxes smartly to maximize your savings. Understand income tax law, the recent changes, new tax regime, right? What are the deductions? So, you know that our finance minister is expecting you to spend 100 rupees if you earn, all 100 rupees need to be spent. That is what the new tax regime. They are slowly erode the old tax regime. Old tax regime is given the opportunity for saving. New tax regime, no saving, spend everything, give it to the company. Money need to be floated. That is a government strategy they are implementing. Now look at that. Comparatively for the last year, up to 12 lakh rupees, no tax. But then there is a slab rate. Up to 4 lakh, there is no need to pay even a single rupee as a tax. From 4 to 8 lakhs, 5%. 5% of 4 to 8 lakhs in the sense 4 lakhs rupees you have to pay 5%. 4 lakhs into 5%, 20,000 will come. Next 8 to 12 lakhs. If your income between 8 to 12 lakhs, so another 4 lakhs will come here. If it is your income is 12 lakh in that particular year, 10% of the remaining 4 lakhs will be 40,000. So if your income is up to 12 lakh, then you have to pay 20 plus 40, 60,000 as a tax. Now, provided you are exempted as per the rebate rule. So Government of India is giving according to 87A, so up to 12 lakhs there is no income tax need to be paid. The rebate can be withdrawn at any time. That is the reason they are coming in this way. Right? We have given the rebate. Over the period they will remove. That is what their strategy. It's a government strategy. Fine. So now, please try to understand that. Suppose if I am getting more than 12 lakhs, 16 to 20, 20%, 20 to 24, 25%, 24 lakh plus 30%. Please try to understand that the business is going to pay 25% only. Any business, even Reliance Industry is going to pay only 25% of tax. But as an individual, you have to pay 30%. It's the highest rate of tax for individuals if it is exceed 24 lakhs. Now try to understand that effectively how much you are going to pay. Up to 12 lakh 75,000, there is no need to pay the tax. That is what effectively you are not paying. As government says only 12 lakhs, up to 12 lakhs there is no tax, but you are saying 12 lakh 75,000. Yes, of course. Your earning is 12 lakh 75,000 per annum. Now try to understand that you are eligible for new regime or old regime standard deduction. Standard deduction for the old last year 50,000, this year the new regime it is saying that 75,000. So 75,000 you can deduct from that 12 lakh 75,000, remaining 12 lakhs. So up to 12 lakhs, the taxable income after deducting standard deduction, the taxable income, not total income. Total income 12 lakh 75,000. After deducting your standard deduction 75,000, the taxable income only apply for tax. The taxable income 12 lakhs, so for that there is no tax. Suppose if you are earning 12 lakh 10,000, all the things will enable. Until then it is disabled. When you are earning 12 lakh 10,000 taxable income, I am talking about taxable income after deduction of the standard deduction amount. If it is just 10,000 you are increasing, all things will be enabled. You try to understand that here 20,000 you are going to pay, here 40,000 you are going to pay. So I said 12 lakh 10,000, 10,000, how much you are going to pay? Right? It is for 20%. So it comes around. So in between there is a bracket. Fine. Say for example, 2,000. Right? So 2,000 you are going to pay missing 15%, 12 to 16. That is what I get confused in that